Welcome back to the Hybrid Real Estate Professional Podcast, the show where we explore what it really takes to build wealth through real estate without giving up your life in the process. I am your host, Aaron Amin. Today's episode is a personal one for me, and it will be a solo episode. I'm going to pull back the curtain on what it was like to raise over $2.8 million from investors to fund our first memory care development project, Everwood Reserve. Whether you're raising capital now or just starting to think about it, this one is for you. And before you hit skip, even if you are a single family investor or even brand new to investing, I encourage you to consider how this might relate to you, whether it's now or in the future. It was less than a year ago that we decided to embark on this project, so believe me when I say things can change very quickly. It's been about 4 months since we, in earnest, started preparing for and launching our capital raise campaign. And as of the time of this recording, we just finished it about 4 days ago. So this stuff's very fresh for me. But I wanted to kind of try and create some buckets of lessons that I learned. So some of this might sound obvious, but believe me, it is worth digging into and internalizing. So first, you raise capital at the speed of trust. This is ultimately a trust game. A good deal is a core component of what people are investing in, but there is a much larger component of whether they believe that you and your team are the right ones to steward their money and take care of it and execute the plan that makes that deal good. So a poor operator or someone who's not trustworthy or someone who can't look someone in the eye and make them feel comfortable, that is going to be a tough sell, even if the deal itself is good. And alternatively, a mediocre deal with a really experienced operator or somebody who has navigated choppy terrain before, if an investor has trust with that person, they might even consider something that is slightly lower projected returns for the sake of being with someone who they trust more to actually take care of their money. You build your credibility long before you launch your campaign, right? So if you think about a lot of people that you might be raising from, especially if it's your first time, are going to be friends, family, connections that you have from different points throughout your life that have known you. They know you well enough to have an idea a bit of how you think. And ultimately, you start putting out signals to the world, before you even conceptualize whatever project you might be raising money for. So for me, I'm grateful to have started writing content and sharing about the experience that we had building our rental portfolio almost 3 years ago now. And so I didn't have any idea that we would be launching a campaign like the one we did, but it was born out of a desire to share some of the lessons that we learned and in the hopes that someone might find value from that. And through the process of starting to put that stuff out there, I built a ton of incredible relationships with investors, again, mostly people that were buying their own rental properties, but that stuff parlays into different types of relationships over time. And so I never had the intention of, I'm going to build this list just so I can eventually raise from them. That's the furthest thing from the truth, actually. But what I did do is start creating a public persona and a public brand so that if people do consider our deal and they look in, who is this guy? They can see, right? Like, I'm out there actively, I'm putting out a podcast, I'm engaging with people, I'm answering questions, and I'm broadcasting the things that I learned. That is actually a very important asset for due diligence that I learned was even more important than I thought. So take that for what it's worth. If you think this is something you ever want to do, I would highly suggest finding some way to start sharing about what you're doing. Second lesson, deadlines create momentum, but only if you honor them, right? So this is one of the hardest lessons that we learned is pacing. So we actually ran our offering in 2 different phases. We did, I won't go too deep into the details, but we did a syndicated offering and there were 2 different rounds. One was a 506B, which means we could only raise from people that we had pre-existing and substantive relations with. So I'm not a lawyer. I just want to say that very openly. Please seek your own advice when you are considering launching offers like this. But essentially what that meant is we couldn't talk about it publicly. We couldn't post about return profiles. We couldn't really even suggest that we were raising money during this phase. So we raised over $1 million during that round by going to people that we already knew. We hosted a couple individual office hours. We even just hosted a call to share what the project was. Like, it wasn't an investor pitch or anything. We were just sharing what we were working on. And then we used that to kind of gauge if people were interested. We actually had some people reach out to us after that and express that, hey, if you are raising money for this, give us a call. Let's see, if it's a good fit. So that was an interesting round just because you can't go posting on Facebook far and wide, hey, I'm raising money, I need investors, it's a 20% return. You can't say things like that. So that was about a month, and we had to create deadlines that would give people enough time to make a decision and invest during that phase while still sticking to our overall timeline that we needed to hit the rest of our deadlines. So as with any type of campaign, most of the decisions and most of the funding come towards the very end of it. So if we had a 2-week campaign where we only gave people 2 weeks to decide and fund, we probably would have raised less money, but I bet those same people that committed would have funded by that 2-week deadline. So you really have to kind of manage expectations. You have to manage the flow of conversations. What we wanted to do is give people enough space to make an informed decision, but not give them so much space that it compromised our timeline or that they kind of lose interest or lose steam. Most people don't want to fund any sooner than they have to, which I understand. So when we ran it in 2 rounds, we had that first closing, and then we converted it to what's called a 506c offering. 506c, it does allow you to advertise and quote unquote solicit for investments publicly. But the trade-off is you can only be accredited investors. Accredited investor is someone who either individually makes $200,000 or more in income and has for the previous 2 years with a reasonable expectation to continue in the future, or as a household filing jointly, it would be $300,000 for that income threshold. The other way to qualify is having over $1 million net worth, and that excludes any equity in your primary home. So this, of course, narrows the pool of people who can invest in your deal, but by being able to advertise openly, you can obviously draw from a larger overall pool of people. So when we converted to the second phase, we gave it again about a 4-week period, which is somewhat short when you think about the idea of having to go attract and find new leads and start talking to people and nurturing those relationships who don't have the benefit likely of knowing you for years and years and years. So you have to quickly build trust. You have to make a compelling pitch and show up very well, and you have to run them through all the decision-making process and the funding and signature process. That's a lot of work in a very short amount of time. So I would say don't underestimate that, and make sure the deadlines you set are ones that you actually stick to for the purpose of continuing to drive the whole project forward. So that's something, we might make some adjustments when we do this again. Number 3, investors are not just buying into your deal, they are buying into you. So I kind of hinted at this earlier, but the deal is absolutely a critical part of the economics, the business plan, the demand, whatever the experience, all that stuff. But at the end of the day, there is a very critical component that's hard to define. And that is that people want to look you in the eye and see, how does this person think? How do they respond to questions? Do they seem confident in their plan? Do they seem unsure of themselves? If I ask a question that they don't have an answer to off the cuff, are they responding as someone who has confidence that they can solve the problem? Or are they backing off and showing signs that, they're going to buckle if they hit pressure? That stuff is really important. And as somebody who's invested in other people's deals, I looked for the same thing. I wanted to know, are these people that not only could I get along with or am I aligned with on a values perspective, but do I trust them to make decisions when things don't inevitably stick exactly to the plan that they forecasted? Our business plan is forecasted over a 10-year time horizon for the investors. So if anybody realistically thinks that everything's going to be exactly penny for penny, situation for situation over a 10-year period, I've got news for you. That's very unlikely, right? So at the end of the day, people need to trust our ability and our team, how we think, how we operate, to make decisions that will guide us to the best possible outcome for their investment. Number 4, not all no's are permanent. So this is an interesting, I really don't like selling things, and I try not to think of this as selling things. Essentially, in my mind, it's presenting an opportunity that hopefully has reciprocal benefits for both parties. The investor gets to be involved in the project that delivers, very favorable returns, especially compared to a lot of the alternatives. They also get to participate in the impact of the project that we're making. But also, of course, we need the money in order to fund it. What happens is timing is a big component of this. A lot of people that want to invest might not be liquid right now. They don't have the capital, or they're not, the timing's just not right for whatever reason. And that doesn't mean that you just slam the door shut and you say, well, you are of no use to me, so I'm not talking to you again. These are long-term relationships that you can build and nurture. And even if you don't have line of sight on doing another deal, just know that these are people that clearly, if you're having a conversation with them, that means they've expressed some sort of interest in getting to know you and what you're doing. And so I think, understanding and taking that mindset of this is not a permanent no per se, unless they actually say, no, stop calling me. Keep those people in mind. Keep them updated. Maybe put them on a separate tag in your email CRM so that when you send updates, maybe every third update or maybe the high level updates, you ping those people and say, here's how the project's going. Like, here's how we're doing now. In our case, this is the first time we're operating a deal of this magnitude. So I think a lot of people also want to see, if they didn't jump in round one, well, were they making the right decision because they weren't fully confident in you? Or are they going to feel some FOMO if they see you posting about how well the project's doing and some of the key features and highlights of what you're doing once you actually get online? So I think that that's the idea of retaining these relationships for the long term has been important in my understanding of how to raise capital. The other thing too is that with sales, follow up, if you talk to anybody in just about any profession, following up is an important part of it. There are several instances in this campaign where there are people that we are very happy joined us and they're aligned with our values. There's so many things that are great about having them on the team, but they kind of disappeared for a little bit, right? Or I had to reach out 3 or 4 times. Sometimes I didn't get a response a few times in a row. I don't like bugging people, but what we needed was a resolution. Are you a yes? Are you a no? Or are you a now's not the right time and call me a different time? We need to be able to categorize people into one of those areas. If somebody says no, we will stop contacting them. So the follow-up was key because we had to push past some of that discomfort and actually, continue to follow up until we got to one of those 3 labels. And it's really doing everybody a favor, honestly. Like if somebody's on a list, that means that at one point they expressed interest. So we're not just picking up the phone and cold calling random people and asking them if they want to invest $100,000 in a memory care development project. These are people who expressed interest. So all we're trying to do is get to the conclusion. Are you in? Are you out? Or are you someday maybe? And the last thing I will say, is kind of a synthesis of all this, is you have to keep showing up every day with the full confidence that the campaign is going to close and you're going to fund your deal. It is really hard to do that. Our target was $2.8 million. That's a lot of money, especially when our entry point, our minimum was $50,000. To raise $2.8 million in $50,000 increments over 2.5 months would be very difficult, right? We're lucky that we were able to have a mix of people investing $50,000 and also a few people that came in significantly higher than that. And if it weren't for some of the conviction and confidence that not only do we have a great opportunity, not only do we have a great team, but this is going to move forward. If you give off any indication that you don't believe in your own project, then how could you expect somebody to not only believe in your project, but invest a lot of their money with you? I sure wouldn't, right? I want to see confidence. I don't want to see arrogance. I don't want to see people being cocky or unrealistic, but I do want to see conviction combined with a little bit of humility that, we are not trying to play some divine power. We are trying to put together the right team, identify the right types of opportunities, and bring it to the market so that we can fund it and get it online and start changing the community, impacting the community around us. And in our case, we're very, very happy that we have a mission-driven business. There's a true need for this for seniors in our community and beyond. And we are taking step 1 out of what we hope will be many to address that problem and make a difference in the world. So those are some of the key lessons. I am going to do a lot more deep dives within the community I run. And I'm also going to be putting this out a little more detailed on my email list. So if you are not on any of those, please follow the links in the show notes. And I would love to have you on there. If anybody has questions or wants to reach out and maybe explore what this might look like in their world, just shoot me a note and let me know. I would love to hear from you. So with that is the key lessons I learned from raising $2.8 million for Everwood Reserve, and we will catch you next time.